Good morning, Brian Hale here. Please forgive my voice. I managed to pick up something at a regulatory conference down in San Antonio this week. I may have shaken too many hands and not used enough disinfectant. So again, forgive the voice. So it's Monday morning, February 19th. In today's post, we have our newsletter that we're posting up, as well as the link to subscribe to the newsletter if you'd like to get it on Fridays as opposed to Monday when we post it publicly. This week's newsletter talks about the fact that obviously rates have bounced back up due to some unfortunate inflation data that we got in the past week. We had CPI come out this week, only really marginally hotter than was expected, but really moved the markets, and then followed on Friday by PPI, the wholesale producer price index, came out materially higher than expected. And although the markets tend to be less sensitive to the PPI data in general, fortunately, all of the progress that we made in the course of the week after the consumer price index came out, we kind of lost at the end of the week when PPI kind of doubled down and gave a secondary vote to the fact that inflation is not yet dead. So out of that, obviously, there was a lot of hope late last year and coming into this year that the Fed might be cutting interest rates by March, maybe 6 cuts this year. Clearly, those are off the table in terms of the number. Most analysts believe that the March cuts are off the table. And I think, unfortunately, there's a creeping sense that there's maybe a 20% chance that yet this year we could see a Fed rate increase. Now, that would be, I think, really uncalled for unless there's additional data that comes out in March that would bolster the idea that inflation is heating back up. In truth, the economy is doing pretty well. The Dow, or many of the stock indexes, are sitting at record highs or near record highs. The jobs report continues to show, earlier this month, twice what the expectation was in terms of new jobs creation. So clearly the Fed has not reined it in yet. That said, we have a new set of data coming in March. It'll be interesting to see what happens. The reality is that we've lost about 50 basis points at rates, and rates have ticked back up over 7%, where they had dropped down into the mid-sixes for a period of time. Spreads remain uncomfortably high, almost at historic highs in terms of interest rate spread over the 10-year. And so I'm fighting through this voice today. I'm in the third hotel room in 6 days. I'm on an 8-day business trip, and but I wanted to make sure we got this out so that people could read through the information. There's a lot of data, some great charts in this week's newsletter. There's a kind of a recitation of recent reports that have come out in terms of the data that associated with those reports. The only real thing I think of substance that's about to come out over the next couple of days or a week or so is the Fed's minutes out of the FOMC, the Fed Open Market Committee minutes from their most recent meeting. That can have a tendency to move the market one direction or another. So I encourage you to either read this week's newsletter and to subscribe. Again, I can't emphasize, you can't beat the price. It's free. Subscriptions continue to be very strong. We're in the thousands now subscribing to this. And I think particularly if you're a loan officer or a branch manager in the business today, this letter can help you with explaining what's going on in the market to your clients, your referral sources, your customers. And again, if you subscribe to it, you get it on Friday, so you have it for the weekend when you're talking to a lot of consumers. So with that said, I'm going to give my voice a rest. I'm going to sign off, wish you all the best this week, and look forward to talking to you again next week, hopefully with a better voice. Talk to you soon. Thank you, and have a great week.